All right, here we go. Hey everybody, what's going on? My name is Arman Vakili and this is Stock Splits, the show where we talk about stocks that split. Super creative, right? Today's example, actually, no, before I even jump into it, I haven't done this in a couple of weeks, so I kind of forgot the flow of it. What is a stock split first? Let's talk about that, right? So, what is an actual stock split? A stock split is when a company divides its existing shares into multiple new shares to boost liquidity, is one of the main reasons why it's been listed online, but it also helps to get new investors come into the marketplace because the stock price has dropped. This was especially prior to an era where you couldn't buy portions of a stock and you had to buy full actual individual shares of a stock, or you needed access to like a great brokerage account through a great broker to be able to buy portions or maybe buy certain pieces of it. So this was prior to that era that this whole stock split concept was kind of brought up and thought up, and it helps with gaining new investors. But now it's not as big of a deal. But anyway, we'll talk about that. So, although the number of shares increases, so the number of units of shares increases by the multiple, the actual dollar value of the shares stays the same because it doesn't actually add any real value to your account. So that example looks like this. So if you have before split, you have 2,000 shares in your account, in your portfolio, and the value was $300 a share. After the split, it might be a 3-to-2 split, right? So if it's after the split and it's 3-to-2, it means that each one of those single 2,000 shares will split into 3-to-1, 3-to-1. My apologies. So 3-to-1. Each one of those things is going to be split into 3 new shares. So each one share is going to be split into 3 shares. And if you have a 3-to-1 split, then your 2,000 shares will turn into 6,000 shares, but the price of the shares adjust so that your overall account value is still $6,000, or not $6,000. This is probably, what is that? $600,000. $600,000 would be the overall account value, right? And so that's the case. And the actual value of the account doesn't change. But again, what it does is that when the price has dropped, especially in a pre-internet era, $100 price point is easier for people to get access to than a $300 price point, which means by extension, there's more investors available and there will be new investors that come in, which means that the market cap for the company will grow, and then we'll see actual performance examples for today's or for this week's, or however frequently this gets distributed. But for this example, we'll be talking about what let's just go into it. So Boeing is our case study for today. In case you have not heard of Boeing, they're an aircraft, I forget, like aero something. They're in the aerospace field, right? They have planes, they provide commercial flights, etc., etc. So now Boeing historically has had 8 splits. They've had 8 times that they've split their stock. The first one was in 1966, and it was a 2-for-1. 1977 was a 2-for-1. 79 was a 3-for-2. 80, 3-for-2. 85, 3-for-2. 89, 3-for-2. 1990, 3-for-2. And the last one was 1997, which was a 2-for-1. And so you have 8 splits, right? And then we're looking at these different time zones, and I'm actually going to keep my notes in front of me so I can kind of address these individual times as we go through our graphic performance, our historical graph performance. So I'm going to get out of this thing, and I'm going to move to my next tab, and I think there's a little, okay, cool. So this is the stock price history. First, let's look at the stock price history of Boeing, and this is the max history from the very, very beginning. From 81 is actually what we have on here. So I don't have the 66, 77, 79, and 1980. I don't have those splits on this timeline. But even considering all of those splits, the actual value of the stock was $5 in April 10th of 81. And so if we went to 85, which was the next split, and so if we went to April of 85, let's go April of 85 right here around this time, still not much of a gain that has happened, and this was a 3-for-2 split, right? So not really great gains that took place, but you can see that this thing's like pretty much touching the line down here, and it's separated from the line. So at least it's not touching the line anymore, and there's like a bit of a steady growth slump or growth slant that's taking place right here. And so if we went to 1989 now, And this is probably around the time that we did, if we did, I'm just going to do April because I don't exactly know the specific date of the, actually, let me see if it's listed right here. If we look at the 1989 split, it happened June 12th of 89 is when it happened. So if we do June 12th of 89, it would be around right here. Blackout, right there. So June 89, around that time. So this is around the time that the stock split was announced. And we could actually see that there was a relatively decent growth spurt that's taking place right here. And so 89 it was announced, or June of 89 it was announced. And when it was announced, it's at 1650. So the price point that it was at prior to this one, so which was 85. So it was 1650 right here. And if we go back to 85, the price point in 85 was about $9-10. So it's been a decent 50% to 60% increase that took place between these two splits. And then you have the 1990 split. So you had the 1989 June split, which was right here, and it's at 1675. And if we went and looked at this over here and tried to find the 1990, can I zoom in? Oh, boom, I can zoom in. So if we looked at the, June 12, 1989, 342 split, and then the next one was June 11, 1990. So it was the next June that happened. And so we had June of 89, we were at about $16. And then if we go to June of 90, we're at $28. That's it's a pretty steep little jump right there. And if you could actually also see that there's a dip that took place right after that stock split that took place. But the spike was there, right? So the market looks at it and the announcement is made, and there was an 89 announcement, and in the 89 announcement, since the last split, the stock had gone up 50% from the last one from 85 to 89. And so when they announced another one in 1990, obviously there's a pretty nice spike that takes place, and it went from the $16 that it was, and it went up to $29, right? And then right after that, the dip started taking place, but the lowest that it went was $20 after that. So after the $16, it didn't go back down to 16 until much. I don't think it ever went down to 16 ever again. So it's never gone down below that number. So that was our 1990 split. And then the very last one that they had was a 97. And so I'm going to guess that it was probably also June of 97, which was at $55. So this was 29, 20, and then it dropped back down to, let's say, $20 right here. And it went from $20 to $55 in 97, which we have our peak right here. So July of 97, $58 in 97, and it was June of 97, which was the last split that this company experienced. So since then, they have not opened the market up in that way, meaning that they haven't invited a grand market investment by doing another split. Typically the split, because there is this announcement that's made that, hey, company XYZ is going to be doing a split on so-and-so date, and you could literally Google upcoming stock splits, so you can actually put it on your calendar and analyze the performance of certain companies when they make these announcements. What does it look like before the stock split? What does it look like during the split, or like right as it's taking place? What does it look like after the split took place? What was the valuation of the company? We're going to look at market cap in a little bit. What were some of these things that took place around these dates, and what happened to the growth of the company after that? And really, honestly, when you look at this is actually not a bad growth rate, because the typical corrections affect this company just like every other company. So in early 2001, this was around the time that the United States went to war with Iraq. There was the 9/11 Twin Towers thing, and there was like a lot of chaos and commotion that was taking place within the market. So there is a natural dip that took place. This was a proper correction, and the S&P 500 took a dip as well. So most companies, if not all companies, took a hit during this time. And then this was around the mortgage bubble building, and everybody's developing all these inflated wealth, and there was a lot of travel probably taking place, and a lot of people are going different places. And then the bubble burst in 2007, and a lot of that wealth was lost. And obviously, people who had money in the market, or who had money in Boeing or whatever it was, there was a dip that took place because, number one, the market crashed. Number two, because of the fact that people are losing their wealth, their inflated fake wealth that they didn't even really have, because they had mortgaged and remortgaged themselves so many freaking times. Because that dip took place, there weren't as many people that were able to use, not use planes, but like fly different places and travel. So that was a pretty big hit. But again, this dip that you see right here, this applied to everybody. And ever since then, they've actually had an excellent growth rate. And I believe this was around the time that they also went into the space world, where Boeing, because I think Boeing has a contract with NASA and possibly even with SpaceX, Elon's company. And so they got a really, really great contract. 2018, significant dip right here, but it was a short-lived dip because it was a span of maybe a month and a half, and immediately they had a spike. And early 2020, this is heavy. This was very, very heavy. And I think this is, I can't recall whether or not we've done any airplane companies or like flight companies, air travel companies on this show yet, but this is a huge dip right here because these guys, when the world got locked down due to the pandemic and COVID and all these things, travel was locked down across the world. Like countries, the United States has a travel freeze, and there were a lot of different countries that had travel freezes, and you know they were trying to quarantine everybody and stay within the place, so there was nobody traveling. And there's been spikes and dips and spikes and dips. And recently, so if we were to look at, let's say, the last year, this is what the last year looks like. And this is pretty much right after the pandemic. So it happened in March of 2020. So right after the pandemic, and then spike and a little bit of a dip, and then a spike and a little bit of a dip, and then a spike. And so it's still going to be in this, I think, pattern until there's an official release where everybody is allowed to travel, and the vaccines, I guess, have been taken care of, and most people have had them, and they're allowed to now move from place to place and travel from place to place. So this will end up being something that I believe personally, just based on my opinion, and you can get this verified with a securities advisor or something like that, but I believe that this is not a bad company to look at because they've been established. It's a pretty long lasting. They've been around. Their original split that I found was 1966. So that means they've been around prior to 66, probably maybe a couple of decades prior to that. So they've definitely lasted through several economic recessions and depressions, maybe even. And they've made it, and they locked a contract where they are not just focused on Earth travel, but they're also focusing on space travel, which I think is going to also make them a pretty viable competitor when it comes down to the air travel industry for the next 20, 30 years. So this is what it looked like on their stock performance, right? The actual stock performance of these people. And then we kind of looked at what it was like after and before the splits took place. Now, if we were to look at the market cap of this company and the amount of money that was invested within them, and I only have, again, so this, unfortunately, and I need to find like a better one or something like that, but the market cap information that we have available in all of the examples that we've done so far kind of started at around 2005. That was weird. I just heard my own voice. That was weird. What was that? That was weird. Started around 2005. So for 2005, the net worth, or the market cap, that the Boeing had available was $45 billion, okay? And after the crash happened, right, this was the 2008 mortgage bubble bursting. After this took place, obviously, they took a really big hit because travel is one of the things that is like the first thing that people cut down on because it's like a leisurely thing. And so big hit right here. And then the bubble has been built. This is no longer a mortgage bubble that's been building right here. But the increase, as you see, pretty steady increase in market cap, and it got to the point that because they had their spike right before this crash, the first spike was around 77 billion. And so it took some time for them to get back to the 70 billion mark, which was 2013. So it's approximately 5 years after. So it took them about 5 years to recover from this thing. But ever since then, the only major, and this is actually really crazy, that like their market cap dropped back down to 53 billion because of the pandemic. This is insane because March is literally when the lockdown happened in the United States, and something like that taking a hit on a company like this, and it provides so much opportunity for investors, because if you're looking at a company like this, and a situation like this takes place, there's a reason why they say a lot of wealth is generated through depressions or through recessions, because when dips like this take place, people who have liquid cash that they're sitting on are waiting for something like this so they could buy it on sale, and then it dropped back down. And the market, even though the market cap was at 53 billion in 2020, as early or as recent as 2020, it shot back down by March of 2021 and it's at 143 billion. So you have to understand, this is a great pattern. This is like a very, very interesting thing to look at, is that when you see, and this is very, it's also something to consider, because this area right here, this volatile time that you see right here, these are signs that you're about to see a correction taking place. When there's a big spike taking place like this, there's typically an era that is followed that is pretty volatile like this, and then a correction takes place. And so when you see a spike, a little bit of volatility, correction took place. You saw a spike right here, a little bit of volatility, correction took place. Then you see another spike, a little bit of volatility, correction takes place. Volatility, correction takes place. So you see this pattern. This is actually something that you can track most companies with, and it's very similar. You will see a spike, there will be some volatility where it kind of like plateaus, and then correction takes place, and there will be another spike. And typically, unless there's something as catastrophic as a pandemic, which even though there was a pandemic, there still was a recovery. There was a very quick and major recovery that took place. But even if there is something like this, it's just there's so much opportunity available for investors. And so when I started investing directly into the stock market, because most of the time I've been in indexed accounts and annuities and things like that, and when I started buying individual stocks and purchasing stocks and getting into the investment world, it was actually right after the pandemic took place, because I saw a huge dip, and I had heard so many times from my mentors, from different teachers, that when you see a dip like this take place, you better be ready to buy, because everything's going to be on discount, everything's going to be on sale. And sure enough, every company took a big hit, and every company was on sale. And so I bought whatever I could. And since the pandemic, including the pandemic, because it was like right before the major dip took place, but including the pandemic and that entire thing that happened, and then there was a little bit of a correction that also happened at the beginning of 2021, including both of those, the value of my portfolio has been up 150% because I bought at such a low place. And so the reason why this stock splits and this whole thing, the reason why this is actually important is so that you actually get to, like, when you study these patterns and when you study these things, and then you combine a few different things together, meaning you study the pattern of the company, their longevity, then you study whether or not they have scheduled stock splits announced that are coming up, you study whether or not they have proper contracts in place, that they're looking for expansion and they're looking for growth. And a few of these elements, as long as a few of these elements are in place, you have a pretty decent acquisition that you can make. So again, I'm not a licensed securities advisor, I'm not a licensed stockbroker. So go talk to somebody that is licensed so that you can get the official advice, yada, yada, yada. But it really helps a lot when you're self-read as well, and you study and you get yourself into this information and really just kind of dive deep into this world. So very, very interesting stock to look at, very interesting company to look at. I'm very curious to see what your feedback is going to be on this company. And if you have any questions, obviously, I would love to hear it. And we will either try to address it in the comments or just in future videos. And we'll talk. We'll have a discourse. We'll have a proper back and forth conversation. So this was Stock Splits. My name is Arman Vakili. Thanks for hanging out. And we'll see you in the next one.